o'clock, according to my watch down here in Florida. I hope it's the same time in Kentucky. I assume it is, but we can proceed. Please let us live. Thank you.
We're live.
Good afternoon, everyone. I'd like to call to order the February 26th, 2025 regular meeting of the CERS Investment Committee. I'd like to begin with the opening statement, and Philip, I believe you're going to do that for us. Is that correct?
Do it.
Thank you.
This is the regular meeting of the County Employees Retirement System Board of Trustees Investment Committee. This meeting is being broadcast via video teleconference pursuant to KRS 61826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public live via Facebook. If you're speaking and not appearing by video, please identify yourself before talking. If the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If the connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to a later date.
Thank you. Sandy, would you please take the roll?
I'd be happy to. Dr. Hackbart.
Here.
Mr. Cheatham.
Here.
Dr. Milkman. Mr. O'Mara.
Here.
And Ms. Pendergrass.
Here.
Thank you.
The next item is public comment, but I believe, Sandy, we do not have any public comments this afternoon. Is that correct?
That is correct. No public comment.
Good, thank you. We have minutes to approve. We have 4 meeting minutes that we have to go through this afternoon and approve. I think we'll do those individually. The first one is a revised version of the August 15th, 2024 meeting. Would someone please move to approve those minutes?
So moved.
Is there any conversation? If not, someone in the second. I forgot to get a second. Is there a second, please?
Second.
Thank you. I have motions made and second to approve the August 15, 2024 minutes of the regular meeting. All in favor, please signify by saying aye.
Aye.
Same procedure for the November 18th meeting. The minutes have been distributed. Would someone please move to approve the November 18th, 2024 meeting minutes?
So moved.
Second, please. Okay, motion made second. Any modifications or changes in those minutes? If not, with all those in favor, please signify by saying aye.
Aye.
Motion carries. Thank you. Next, the November 26, 2024 meeting minutes. Would someone please move to accept those minutes?
So moved.
Is there a second,
Second.
please? Second, got a second. Thank you. Appreciate that. Any comments or changes on those minutes? If not, all those in favor, please signify by saying aye.
Aye.
Opposed? Motion carries. Those minutes are approved. And finally, the December 19th, 2024 meeting minutes. Would someone please move to accept those?
So moved.
Thank you, Bill.
I'll second.
Thank you. Motion's made to second. Any comments or changes for the December 19th, 2024 minutes? If not, we'll proceed to vote. All in favor, please signify by saying aye.
Aye.
Opposed? Motion carries. Those minutes have been approved. Next item on our agenda this afternoon is the CERS Quarterly Investment Review. Steve Weiler, if you would proceed, and also any comments from Wilshire would be appreciated as well. So please proceed.
Sure. Good afternoon. Appreciating that we have a very full agenda today, including some investment recommendations that we're excited to present to the committee. I would like to ask Wilshire to briefly cover and provide an overview of the economic and market conditions for the last quarter.
Thank you, Steve. And we promise to be brief as you requested. I'll just go to a few points. First, I'll just a little bit of a narrative. It's not on any particular page in front of you right now, but 2024 was another strong year in the U.S. equity market. This has certainly been good for almost all institutional portfolios, assuming that almost all institutional portfolios are invested to some degree in U.S. equity. But a continued strong market resilience, up around 24% for equities in the U.S., followed by 26% last year. So from that one asset class, you can think about assets have compounded by 50+% over the last 2 years, coming off of 2022 where assets declined quite significantly. So that's helped a lot for a trailing 3-year return. And I'll just go over for a minute to slide. If we could start on 27, please. And I'll just touch here, like sort of equity returns we just talked about, and then we'll talk about rates on page 27. We'll talk about rates. Here, just that top section is the rise and fall of the 10-year nominal return throughout calendar 24. Just remember that when rates go up, bond prices go down and vice versa. So the first third of the year, we had rates rising, prices falling. Second, maybe 35-40% of the year, we had rates falling, prices rising. We sat at the end of September with a nice positive return to bonds, and then we wiped that out in the fourth quarter. So it's basically been about a 4.0 to 4.7% range on the 10-year Treasury throughout the year of 2024, fair amount of volatility, as you can see. And all of that led to a return of the aggregate index, the Bloomberg aggregate index, of just a little over 1% for the calendar year. So that gives you sort of a sense of rates. We're actually a bit lower today. The 10-year today is sitting at 4.25, so rates back down a little bit. But rates and inflation and geopolitical issues, elections, all of those things were a big part of our calendar year 24, still are stepping into this year. If we could go out to the next page, just 28, please. And here we have a chart of debt and deficits, both continuing essentially to rise. And we all know the story there. A lot of political emphasis on this story. We don't have the expertise to opine on where that will go from a political standpoint. But what we can say is even with rising debt and rising deficits, the market has just shrugged this stuff off. And in the U.S., there have been strong earnings, and there's been a lot of just positive activity and trading in the U.S. equity market that led to the returns that we just showed. So if we think about what does that mean for forward-looking capital market assumptions, if we could go out to 31, please, and I'll just here talk a little bit about a couple of key points in our forward-looking capital market assumptions. These are for 10 years, but we revisit them at the end of every quarter. And so there are changes quarter by quarter as we look out into a 10-year period based on valuation levels of certain assets and based on rates, et cetera. And the things that we'll point out here that are important are that we continue to forecast what we call a negative equity risk premium. And what we mean by that is just basically stocks minus bonds. Generally, over long-term equilibrium periods, we expect stocks to outperform bonds. Over the next 10 years, we actually don't see that. If you look most of the way down that top right chart to the U.S. stock line, and look over to the part circled in red at December of 2024. So the end of the calendar year, our forward-looking return for stocks in the U.S. is 4.35%. Rise up above that a little bit to the line core bonds in the middle of the green circle, and that's 5.2%. That is what we mean by negative equity risk premium. This doesn't mean that we'd recommend you don't hold U.S. stocks, but we're just pointing out that valuations are very high and in equities, and that says a lot about how we go forward. And also rates are also back up again in general terms, which gives us an opportunity to look at yield and expectations from fixed income going forward. Additionally, plenty of other things in your portfolio that are not U.S. equity and that are projected to perform quite well, particularly private credit, even high yield and private equity. So a lot of good things happening in your portfolio from a diversification standpoint. that can still lead to, solid returns looking forward. But I'll just go over to one more piece, slide 32, please. From 32 to 35, we've plotted some decades that you might find interesting just to look at when you have more time. And this particular one at 32 is the US stock market cumulative returns. And the top two lines, sort of orange and red colors, are the 1980s and the 1990s. During those decades, assets appreciated in the US equity market on a cumulative basis by about 400%. Following those decades, we had the decade of the 2000s, which has often been referred to as a flat decade for stocks. And I just point that out because there are periods where we could end up with close to a zero out of stock investments over a 10-year period. This just happens to be calendar year decades. You can measure these a number of ways. You can measure them as we do, and a lot of our deeper dive data off of every month starts a new 10-year or starts a new 20-year period. So we look at all of this, but as we think about that forward-looking expected return to stocks being low, just recognize that we do in fact have periods where we have lived through that. And certainly not what we've done the last 2 years, but it has existed, and this gives you a sense of what that could look like. So I'll just stop there in the spirit of being brief and move over to Craig, and he'll highlight a few more things regarding returns for asset classes this past year.
Thank you, David.
Thanks. I'll start on page 38 and just briefly hit on a few of the economic indicators that we usually speak to in these meetings. So starting with economic growth, the advanced estimate for the fourth quarter came in at 2.3%, so lower than the previous 2 quarters, giving us roughly 2.8% for the full year of 2024, down just very slightly from 2.9% the year before. So close to this 3% growth rate that we've seen for some time now, again, driven by the strength in the consumer, especially in December. People, as expected, found a way to go out and spend for Christmas and the holidays. It was hurt a bit in the fourth quarter by falling exports and lower investment quarter over quarter. And then important to note here that we're referring to real GDP growth here. So real meaning obviously net of inflation. So the price index used for GDP was up to 2.2% in the fourth quarter versus just 1.9%. So part of that drop, that 0.3% of that drop, driven by an uptick in inflation quarter over quarter. So something we obviously want to keep an eye on if we can maintain this relatively steady run of roughly 3% growth that we've had for a number of years now. On the next page, the consumer. We've mentioned this before, that the consumer seems relatively confident, although we just had a reading today from the conference board that was sharply negative and down from 105 in January to 98 for February, with the expectation that it was just going to fall slightly to 103. So surprising there. We had seen a fall in the University of Michigan surveys as well, a slight decline there. And something that we've noted before is that the consumer seems relatively okay with their assessment of where they are today, but the pessimism seems to be creeping in more so in what they expect for the future. So more concerned about inflation, more concerned about what's going to happen to growth going forward, more concerned about the job market coming than necessarily where they are today. And sometimes that has the potential to be self-fulfilling. If you're worried about the future, you start to adapt your buying today. So there's the potential that this negative outlook that consumers seem to have is going to impact their spending. We did see a decline in their spending activity in January, but it's hard to know how much of that was just due to bouncing back from a strong December. So on the consumers got kind of a mixed bag today when we look at their conditions. On the plus side, confidence, like I said, for today is fairly strong. Surveys indicate that their intentions to spend remain relatively strong. Savings rates are up, and wages have been up about 4% year over year. So on the plus side, they have some things going for them, but on the other side, inflation is obviously eating into their purchasing power. Interest rates remain high. Um, Student loans repayment on student loans has restarted, so anyone with loan payments to make has to redivert some of their spending to paying for those loans. And while the savings rate has increased, the amount of deferred savings, that excess savings that people were sitting on has been depleted over the last couple of years. Remember, everyone built up a lot of savings early on in COVID when they couldn't go out and spend as they normally would. So a mixed bag for the consumer and something we'll continue to keep an eye on. On the next page, in business activity, here we see again something that's reflected in what we've talked about in inflation, that manufacturing remains slightly negative, although it did for the first time since 2022 in January move above that 50 line. So manufacturing is no longer in contraction, but has generally in the last few years been weaker than services. Again, this theme that we've mentioned over and over, consumers went from Amazon packages on the doorstep in 2020 and 21 to trying to get back out there and experience things and spend at restaurants and on vacations and airfares 22, 23, 24. So services remains a bit stronger segment of the economy, but like I said, the manufacturing PMI actually did tick above 50 in January, indicating we're no longer in contraction there. And then one more page, 41, and here inflation has ticked up recently from October through January. Saw 0.2, 0.3, 0.4, 0.5 for the monthly readings. That 0.5 capping off in January gives us a 3% year-over-year rate for CPI. So obviously above that 2% alleged 2% target, which might have some wiggle room around it, as the Fed obviously has a dual mandate. It's been largely driven and sticky. A sticky component of that is shelter, which we've talked about also in the past, that the way shelter and as owner equivalent rent is calculated for CPI's purposes, it tends to be sticky and lingers even beyond the period where the increase in rent and home prices has been experienced. So that is something that's going to continue to take a time to roll off. But on the employment side, we have seen relatively strong numbers continue back to 4% unemployment rate in January, even though hiring wasn't particularly strong in that month. Hiring was strong in the fourth quarter, particularly November and December. So we've been in this range of 3.5% to 4.5% unemployment now since October of 2021, really marking kind of the recovery from the real hit to employment we saw during COVID, and it's been pretty steady around what people would generally consider full employment. So remains to be seen how much federal government payrolls are trimmed, and if there's any increase in layoffs in the corporate world. But as of now, the employment picture remains a relatively strong part of the economic outlook. So in the effort to keep it brief, I'll stop there, and unless there's questions, turn it over to Steve and let him talk about your portfolio results.
Well, I think your comments about consumer confidence is a little bit troubling. A drop of 7 points is pretty rapid. I think the instability of the economies and the policy of the new administration raises some real concerns about the general direction of the economy. Certainly the conversation about tariffs is concerning. Certainly we didn't have the elimination of inflation on the first day of the president taking office. So I think there are some reasons to be concerned about consumer confidence. And if the cuts are made at the federal employment levels, they'll have impact on state and local governments throughout the nation, particularly if they hold back on revenues flowing to the communities for various programs. If we have cuts there, that could be another impact. And certainly with Medicaid, apparently the bill is passed. That's going to have repercussions and reverberations throughout the whole healthcare industry. So I'm a bit concerned about the lack of stability of economic policy and the impact of that in terms of consumer confidence. And I think that's going to translate also into business investment confidence as well. So I think we need to be cautious about this year under the relatively unstable policies of what's happening in Washington. Any other questions or comments of our presenter? If not, thank you, Craig. And Steve, if you would give us the quarterly investment budget update. Thank you.
Sure. Page 56, please. And I would echo Dr. Hackbart's comments. While, consumer confidence is a notoriously volatile sentiment indicator, and as Craig mentioned, it has a tendency to be self-fulfilling, and it's about future expectations. I think for any of those, whether consumer or business, uncertainty tends to breed volatility as well as behavioral changes, and I think that's exactly right. I think you commented on exactly our outlook right now. We're a little cautious on markets. I think that advocates for being closer to home and not getting over our skis. So, and not only, I think Craig and David both did a good job of providing a brief overview of the economic conditions and market performance in the quarter and in the last 12 months. And not only did the year see kind of bookend performance, but the quarter was very similar with strong market performance in November, sandwiched between weak markets in October and December, with risk markets struggling in December, failing to build on the Trump bump following the U.S. election that saw markets surge in November, especially segments seen as beneficiaries of lower taxes, regulatory rollbacks, and protectionism. The portfolios ended the quarter giving up some of the gains they achieved during the first quarter of the fiscal year, with the CERS pension composite producing a return of minus 34 basis points for the quarter, and the CERS insurance composite producing a return of minus 40 basis points, both underperforming the benchmark return of positive 6 basis points. Individual portfolio performance for the quarter was tightly grouped, ranging from down 42 basis points to down 34 basis points. During the quarter, the real return and specialty credit portfolios were the standout performers, posting both positive absolute returns and outperforming their benchmark by 278 and 101 basis points, respectively. Fiscal year to date, the CERS pension composite produced a return of 4.54%, and the CERS insurance composite has produced a return of 4.38%, compared to the benchmark return of 4.83%. January performance is still very preliminary, but with risk markets rebounding sharply, the portfolios are indicated up between 300 and 350 basis points for the month. And quickly, for January, we saw U.S. equities were up about 3%, with a rotation and broadening in the markets that saw small cap outperform large caps and value outperform growth. Global equities were up 5%, with European equities broadly outperforming. Core fixed income, high yield, and loans were also all up between 50 and 150 basis points. So a very positive risk-on sentiment in January. We've seen that turn a little bit here in February. Still got a couple of days left, but we'll see how the month turns out. As Wilshire mentioned, markets really grappled with numerous headwinds and unknowns in 2024, kind of despite that very positive public equity performance. Those headwinds and unknowns included the elections, geopolitical risks, uncertain fiscal policies, and what we really saw is the uneven normalization of inflation and labor markets. They talked about kind of that, the unexpected increase in volatility in inflation at the end of the year. All of these really combined to keep fears of a potential recession and stagflation elevated throughout the year. Uncertainty should remain very high in 2025, with risks seemingly asymmetric in our view, as markets react to political shifts and economic data, underscoring what we see as a real new macro environment with a wider range of possible outcomes and persistently high volatility. As we've seen, VIX has recently gone to the near-term high. We expect the VIX to remain elevated, which obviously some call the fear gauge. We would think throughout the balance of 2025, as we face a lot of uncertainties in the market, that VIX index should remain elevated. I think the best way to describe the current state of investor moods, as evident in that confidence index, is the confusion around the Trump policy comes from the acronym T2D2, a little bit Star Wars-ish, and that tariffs and taxes, along with deregulation and deportations. The scope and reach and timing for all policy shifts matter to how the markets and the economy play forward. And while concerns are growing over the U.S. administration's policies, its impact on global growth, and the fraying of long-established economic and political alliances, the headwinds of policy shifts were expected to be matched by tailwinds from tax cuts, lower rates, and deregulations. And we'll all see how that plays out in both the fixed income and equity markets. Page 58, please. Thank you. This is the new report that we started including at the last meeting that highlights the performance for the internally managed portfolios, and these again are at the trust level. Not all portfolios are invested in all of the internal portfolios. The majority of these assets are managed passively and intended to provide inexpensive beta exposure to more efficient markets while providing staff flexibility and rebalancing the overall portfolio asset and risk allocations.
I have an appointment with Dr. Frank in the morning, and I can't remember if it's 8 or 8:30 for me to show up.
Additionally, staff manages a number of proxy portfolios, which serve as transitional positions for alternative, less liquid asset classes, as committed capital is called by managers and staff source new investment opportunities. I would highlight that the internal public equity and core fixed income portfolios performed in line with expectations, producing index-like performance during the quarter, with the exception of the scientific beta portfolio, which is one of the recommendations that Joe is going to cover in more detail. I would also note that the internal large cap and mid cap public equity, as well as core fixed income portfolios, have all produced modest excess returns over longer periods. Page 59, please.
One quick question before you
Absolutely.
leave the internal. One thing that struck me is that on page 56, where we looked at the managed portfolios, and 58, where we looked at the internal is beating their index, except on a couple of places, and the externally managed portfolios are not meeting their indexes with a couple of exceptions. So kudos to the staff. You are doing really well.
Well, thank you. We don't, I think obviously it's a point in time, and we expect those external managers, obviously, when we do our due diligence and bring those on board, we expect alpha production over time. So, but we're happy to report that the internal portfolios have performed well, certainly over the recent periods.
I just wanted you to know that somebody noticed.
I appreciate that, Betty. Thank you very much. We'll take it where we can get it. So, page 59. And speaking of Ms. Pendergrass, this is one of the reports that she originally requested. In this, while the prior reports show asset class level performance at the trust level, these reports show asset class performance at the individual portfolio level. And I would note that, as we previously discussed, these reports that are generated from BNY currently are only able to show gross performance. We're working with BNY to determine whether they can provide the net level performance for individual portfolios. And we're also looking at utilizing the Slovis analytics module to potentially produce this reporting. We're not there yet, but we hope to be able to bring to the investment committee actual net level performance for the individual asset classes at the portfolio level in the near future.
Those returns in the ITD column look like maybe they're off by a decimal point.
They might be. This is this is a generated report. They could be off. Yeah, I will take a look at that, certainly, Betty. Thank you. A few things I would note on the report, in addition to Betty's comment, is while performance for each of the asset class at the portfolio level is tightly grouped, there are differences based on the specific allocation of each portfolio to the underlying mandates that make up each asset class. The largest divergencies are in what is currently on this report, the alternative asset class. The next time you see this report, it will align with the IPS asset classes. It didn't for this one. And that divergence is primarily driven by the private equity allocations. There's a fair degree of difference between the individual portfolios and their allocations to the underlying private equity mandates. Additionally, in that other category, which is really a catch-all category that BNY uses, you notice it's very small from a dollar amount basis, but that's used to account for administrative fees and expenses. So the returns in there, while they look outsized, really are just accounting for fees and expenses on a very small asset base. I'll pause there with questions. That was a new report as well.
Maybe just a quick question, Steve.
Sure.
I think you mentioned in terms of activities and policies which may offset maybe and encourage consumer behavior and consumer confidence. One you mentioned was the tax cut. It's really not a tax cut. It's just a reenactment of tax policies which presently exist due to the sunsetting of the original tax cut legislation of a few years
Correct.
ago. So it's really not a new fiscal stimulus. It's more or less a continuation of the tax cuts which have been in existence, which presumably have basically guided corporate policy decision-making and at least in the upper income groups as well. So it's
Well,
really,
we
right.
know current activity is going to be based on future expectations, and the expectations that there was going to sunset altered behavior, and
Right.
if that were to become the expectation that they would be maintained, behavior would change as well.
I assume
But
though
I
that
agree.
they assume they would be continued. It's very difficult to take away tax cuts which have been enacted previously. So if you just look at history in the United States, typically we're very willing to have tax cuts, but to reenact new taxes or basically to eliminate those tax cuts, if you look at policies over time, it just doesn't happen very often. So I assume that most individuals that were going to be affected assume that those tax policies would be reenacted, and therefore I don't think it's really a fiscal stimulus, but basically continuation of the current policies and the current situation relative to tax policy, and will affect their decisions both in terms of investment, consumption, and so forth accordingly. So just wanted to suggest that. So
No, I think that certainly makes sense.
right.
Page 78, please. Thank you. Across the portfolios, the largest contributor to outperformance relative to the benchmark during the quarter was outperformance in the specialty credit portfolio, as managers produced positive excess performance across the board. Overall, the specialty credit portfolio produced a return of 2.26% for the quarter, compared to the blended benchmark return of 1.22. Over the last 12 months, this portfolio has outperformed its benchmark by 250 basis points. And outperformance in the real return portfolio also benefited overall performance. And despite declining nearly 7% in December, the portfolio's MLP exposure has gained 13.7% for the quarter versus its benchmark return of 4.9%. And that account was up more than 46% calendar year 2024. As we've talked about, strong cash flows, disciplined CapEx, and consolidation continued to benefit the industry. And that mandate has participated in that the tailwind for the industry. Relative underperformance in the private equity portfolio that we've discussed at length compared to its public market benchmark was the largest driver of underperformance. This portfolio trailed its public market benchmark by 600 basis points during the quarter, and this underperformance accounted for 100 to 150% of the total underperformance at the portfolio level for the quarter. So all of the portfolios would have outperformed their benchmark by about 20 basis points during the quarter if we exclude private equity. Over the last 12 months, the private equity portfolio has underperformed the public equity benchmark by 34%. As we've discussed, this situation is not unique to the CERS private equity investments. Private equity markets have broadly produced positive returns, and the short-term performance for all alternative asset classes have lagged the sharply rising U.S. equity market, with the S&P and Russell 3000 both gaining over 35% for the trailing one-year period that ended 9/30. Again, the marks for these are delayed a quarter. For the quarter, our private equity portfolio produced returns in line with the broader private equity markets, which were indicated up 2.2%. We are working with Wilshire to evaluate potential alternatives or additional performance benchmarks, as we've discussed, for the asset class that better reflect the actual investment opportunity set. We also continue to have discussions with other pension plans and market participants to understand how they benchmark their private equity investments, and we hope to bring a recommendation to the committee at the next regular meeting. The global public equity return minus 1.55%. Yes.
Sorry to interrupt. I just
Sure,
want
no
to
problem.
clarify. planning to bring a recommendation on a new benchmark. Is that?
So the alternatives, yes, either an additional benchmark, as we talked about in the past, we had a short-term benchmark for private equity and then a long-term benchmark for private equity, which was inside of 5 years and beyond 5 years. And that's a lot of peers do it that way. They have a short-term benchmark and a long-term benchmark. So we're not sure if the recommendation will include just a change to the overall benchmark, or if we'll actually recommend incorporating a short-term and long-term benchmark.
David, you got thoughts on that?
Sure. I was just going to add, Steve,
problem here.
I was just going to add to what Steve was saying. This is an issue that institutional investors face quite frequently, especially when we have periods of strong positive or negative returns in public markets. The gaps in the short term between a private markets portfolio and a public markets portfolio can just be very wide. So there's sort of a continual effort to try to benchmark that the best that you can. I will emphasize that one of the most important thing for all of you to look at in terms of your private markets exposure, and Steve, please let me know if you disagree, and that is that the internal rate of return calculation that is done for your private equity portfolio versus a public market equivalent, which is showing the return comparison if all of your cash flows that were invested in private markets were actually invested in public markets. How does that differ? That's the most pure approach that you can use to look at that return difference. And you do actually have that in the private market performance reports that you have. But the reason I raise that is because when we're looking at a portfolio from the top down, these are all time-weighted returns that have to roll up into a total fund calculation. And that's where you get into a lot of this noise between public and private markets. So, Steve, is that fair from your assessment?
Yes, that's fair. And with IRR, there also, we know that there's some gaming that goes on with the internal rate of return calculations for some mandates, and so that's one of the elements. That's why I don't think there's not a consensus across the market as the best way to benchmark. There's again multiple different approaches, and I think that partially is that you need to rely on a couple of different metrics, both to assess the relative performance as well as whether or not an asset class is meeting its performance objectives.
Now, my concern with it is it skews what our performance is versus what our asset allocation benchmark is, which, you're looking, I think, maybe further into the presentation at a 200 or 300 basis point difference between the two. And most of that appears to me that it's coming from the mismatch on the benchmark. We really need to fix that. Based
I
on
agree.
what I'm seeing in the public markets, there seem to be a lot of not only private credit but private equity vehicles out there that have been turned into public market. They may be limited access, whatever. Seems to me those would be a place to look in order to create a more accurate index.
There are a number of providers that aggregate, and again, much like constructing a peer universe, constructing a benchmark relative to the investment opportunity and how the actual portfolio is invested. So as we know with private equity, a big consideration is vintage year. So is our private equity portfolio performing like the broad private equity market? No, because we have a significant vintage year bias. But if we were to benchmark relative to a vintage year construction benchmark that looks similar to ours, I think that's a way to assess. And I agree that, truthfully, any benchmark that is public market plus bogey, as you know, it's not investable. That's not something, it certainly doesn't meet GIPS standards for an investable benchmark. But longer term, that can be an objective of an asset class allocation. That's, ultimately over the longer period of time, over complete market cycles, we want an investment program that achieves a public equity benchmark plus some bogey on top of that. I think that's an objective of it. But I agree, comparing us relative to a benchmark that is a complete mismatch does not provide good information.
Well, it not only doesn't provide good information, it creates an easy way for somebody to sit there and look at it and say, well, your private equity investments aren't performing when they actually are. We really need to get this corrected.
I agree, and I hope we by the next meeting we'll have a recommendation to bring before the committee.
Okay, sorry to interrupt. I wanted to address that while we were there.
That's no worries. I think we'll jump ahead to page 86, please. Thank you. While the portfolio has performed well in absolute terms, as expected, given their modestly lower overall risk profiles and lower allocations generally to public equities, their performance was in line with the median of the broad peer over the last year, a year again where U.S. public equities hit all-time highs. Over the 3 and 5 year periods, as market performance has been extremely volatile, posting years of large positive as well as large negative performance, the portfolios have performed extremely well with top decile or top quartile performance across the board. The lower risk profile of the funds is evident kind of in those standard deviations in the middle graphs relative to the peer universe, ranking in the top quartile. And as always, those graphs on the far right, you can see that bring both of those two things together, that risk and the returns. And all of the portfolios have continued to deliver top decile risk-adjusted returns over longer time periods, really demonstrating the efficiency of their construction and management. We talked about the peer universe, and I know Wilshire has this all public plans total funds universe that they provide, but I wanted to provide some numbers to some other universes that we look at to kind of compare our performance. The pension fund data exchange, the median for the quarter was minus 62 basis points. 25th percentile or top quartile was minus 30. For 1 year, their median was 941. Top quartile was 1039. The Callan large plans, which is over $1 billion, 1 year numbers were 9.2 for the median, and top quartile was 10.2. And then BNY offers a large plan universe as well, which is plans over $1 billion. For the last quarter, the median was minus 60, and the 1 year number, the median is 9.47%, and the top quartile, so 10.33. So again, across those different peer universes, you can see that the performance for the CRS portfolios has been very strong. Page 94, please. Thank you. Happy to report that as of the end of the quarter, all asset classes for all of the portfolios were within their new IPS specified ranges, with the majority of the positioning within 1% of the respected target allocation. During the quarter, we did take opportunities to reduce the overall overweight to global public equities as we rebalanced exposures, but have maintained a modest overweight of approximately 250 basis points. And that's based largely on, as of the end of the quarter, that continued market momentum and economic strength. We balanced this overweight with an underweight in the other component of the growth allocation, which is private equity. As we've mentioned, staff has viewed private equity as having limited value from a relative risk-reward basis, with better opportunities available in other asset classes. I would note that we have, however, begun to focus more on the asset class as recent underperformance and funding difficulties have created a more attractive landscape. So as we move forward this year, we will be taking a hard look at increasing our private equity allocations. In core fixed income portfolio, we're currently neutral overall duration. As you may be aware, we carry a short for a number of years. We don't really find a compelling case. As David mentioned, the volatility in the 10-year has been pretty interesting this year. I think we've traded in about a 70 basis point range already year to date over the first 2 months. So we're anticipating that range-bound trading environment over the balance of the year. As managers have called capital and deployed in real return portfolio, I think over the course of the last quarter, there were both CERS, Maritime, and SVP all had large capital calls, moving our real return allocation closer to their target. Anthony will also be presenting 2 real return investment opportunities later in the presentation, and we're in the final evaluation stages of a few additional opportunities that we would anticipate would bring the portfolios to their target allocations by the end of the fiscal year. I'll pause there for any questions.
Any questions of Steve? Please proceed.
All right, we'll do the next section, which is the investment budget, page 132, please. The investment budget was presented at the Finance Committee meeting on the 17th. The highlights through the first half of the fiscal year, actual expenses were in line with the amount budgeted, with a total of $6 million or 48% of the budget spent year to date. During the quarter, we saw a large uptick in overall legal expenses as activity increased for a number of ongoing cases. As we continue to move through the legal process, we expect these legal expenses will remain high for the remainder of the fiscal year. Page 135, please. Through the first 2 quarters of the fiscal year, investment fees and expenses across the pension and insurance trust were $31.1 million or 32% more than the same period last year, while total assets have increased by 11%. For the period, base investment advisory fees have increased $5.9 million or 15%, which is consistent with the growth in assets and the change in asset allocations. The most significant drivers of the increase in the overall fees and expenses were the rise in the expense category, which includes lines of credit used by individual mandates, which increased by $6.7 million or 20%. Performance fees have also increased by $15.6 million, and that's across specialty credit, real estate, real return, and private equity asset classes. I would note that the $3 million increase in administrative expense line item is largely attributable to those legal expenses I mentioned. These increases account for over 80% of the total increase in fees and expenses. And focusing just on the investment advisory fees, which again are the base fees that the system pays to external managers, I would note the consistency across time with a 25% increase in fees since 2021, which is consistent with the 35% increase in total assets. Currently, the investment advisory fees are running about 31 basis points at the total portfolio level. Performance fees are 26 basis points and expenses are 34 basis points. We continue to see the benefits of restructuring of the core fixed income portfolio, with investment advisory fees only increasing 3% year over year, while assets have increased by 39%. And the core fixed income fees are lower than for the same period in 2023, and that's despite a 56% increase in assets. I'd also note on this page, in response to a request from Ms. Pendergrass, we've included an estimated annualized fee rate for each asset class, both for the overall fees and expenses as well as just for the base fees. And I would caution this is a simplistic approximation using fees paid for the first 2 quarters and the market value as of the end of the quarter. So it does not account for rebalancing our market activity that would actually impact these fees. Any questions on the investment budget?
Good.
If not, I think we can turn it over to Joe for the public equity recommendation.
Well, thank you, Steve, for your very comprehensive presentation. So yes, we'll switch to Joe. And I understand, Joe, you've been looking at some opportunities for us in terms of public equity investment. And if you want to summarize that and any recommendations that you would be presenting to the committee this afternoon.
Yes, sir. I appreciate your time this afternoon. I would point out that I have a memo that was written along with Wilshire's search book that's not been made part of the material. I'll take responsibility for that. Sandy had asked for the presentation material, and I provided her this slide, so I misinterpreted what she was looking for, this slide deck. So we'll make sure that's made part of the board books, and we'll make sure that we get that out to the committee if they choose to want to read a little further into the memo itself. But I'll try to cover as much as possible. Happy to entertain questions. Sandy, if you will slide over to the next one, please. So staff and Wilshire are recommending investments for all CERS portfolios and 2 actively managed U.S. large cap equity mandates to be managed by J.P. Morgan and T. Rowe Price, pending successful investment management agreement negotiations. The primary funding source is going to be the internal U.S. large cap equity factor-based portfolio, with secondary funding to come out of the internal S&P 500 portfolios. It's important to note that no placement agents have been involved with this recommendation, nor will be compensated as a result of any action taken upon it. Sandy, if you'll move to the next one, please. So staff continues to work to improve the public equity allocation. At this time, we think in order to do that, the best course of action would be to terminate the existing U.S. large cap factor-based portfolio. The factor tilts that it seeks to exploit, such as size, value, momentum, and volatility, while they've performed the way we would expect given the market environment, they've just not been able to put together any kind of sustained period that's been rewarding to us. We've experienced a little bit higher tracking error than what we would have expected. And going forward, we think relative performance should be driven by stock selection opposed to some kind of structural bias built into the portfolio. Tactical biases can make sense for asset management. For our portfolio, this factor-based portfolio introduced a structural bias that seemed like it made sense at the time when we brought it into the portfolio. Reevaluating it, don't think that's the best way to access the market at this time. So we want to add value by utilizing a lower tracking error active management with reasonable fees attached to the exposures and the expected relative performance that we would think we can get from that. This report simply serves as a review of the search process that we undertook. We think that our search process complied with the IPS and the procurement policy. Sandy, if you'll slide to the next one. The general process was we started with Wilshire's database. We applied a minimum criteria to cull that list down to something more manageable. We did reserve the right to add strategies to that list if Wilshire's database is self-populating. So sometimes managers just don't participate that we're aware of that we want to include in a search. So we've reserved the right to do that. We did some additional cuts kind of to funnel that list of ideas down. Those were quantitative in nature. We ended up with a list of 7 different firms, 9 different strategies to send out a request for information. They responded to that. Staff and Wilshire reviewed those responses independently, and then we got together and kind of circled up about what we liked and didn't like about different options. From there, we got down to what we called our short list of 4 candidates that we had further discussions with, and ultimately some on-site visits with those managers. Sandy, if you'll go to the next one. Some of the search criteria that we kind of started with just to filter through that data was obviously we wanted them to be U.S. large cap providers. The firm, we want to see a fairly substantial firm with strategy assets of at least $1 billion in assets under management, a live track record of a minimum of 5 years. The firm and team, we needed to be ranked well. So we looked at the research team from Wilshire to see that they had at least a ranking of 3rd decile or better. Over the 1, 3, 5, and 10-year periods, we were looking at relative returns needed to be positive. We wanted to see tracking errors above 1%. Information ratios needed to be at least 0.5. Positive excess Sharpe ratios, and then we wanted up capture ratios in excess of 1, down capture ratios below 1. And then next slide, please. So just to rehash of the candidate pool, our initial cut was about 111 different potential strategies. Through that narrowing process, we ended up, like I said, down to 7 firms, 9 different strategies offered. The short list you'll see there of the 4 that we went for further investigation with was BlackRock, Columbia Threadneedle, JP Morgan, and T. Rowe Price. We'll slide to the next one. JP Morgan, founded in 1863, publicly traded. The firm manages a little over $1 trillion in public equity assets. The strategy we're looking at has about 82 billion in assets under management. The team consists of 3 PMs, highly experienced, average of about 25 years in the industry, 19 years with the firm. They're supported by a team of 18 career sector specialists, equally experienced. Not on this slide, but important to note, those 18 career sector specialists are also supported on a one-for-one basis with a more junior individual who averages roughly 7 years of investment experience. The lead PM is ultimately responsible for portfolio construction and risk management. As far as stability, past few years, they've added a little over, I guess they've added 21 clients. This brings them north of 70 now clients in the strategy. During that time, it's had net inflows of over $700 million. The investment philosophy, the team seeks to understand normalized earnings power of a company. They look to take advantage of any mispricings from near-term information. They believe the information advantage developed through their proprietary fundamental research is really what drives their process. Stock selection, they think they can add value by basically through stock selection in the context of a high conviction portfolio, fully divested, broadly diversified, and style consistent, really kind of a neutral style, which we'll show here in a moment. You'll slide to the next one for me. So the investment process, they try to create a sustainable proprietary information advantage by leveraging their analysts. Like I said earlier, they look to gain an understanding of the dynamics of a business, its growth prospects, and the sustainability of any competitive advantage. So they're looking at things like how capital intensive is the business, the cash flow generation potential, balance sheet strength, return on capital. What's the industry like as far as its structure and growth potential? From a governance perspective, they're looking at the management competence and the way that they allocate capital. So very fundamentally bottom-up driven selection process. They utilize a systematic, valuation process to quantify their forward-looking views. So they're looking at forecasting their long-term earnings and dividends. They're not really that concerned with the next 12 to 18 months. They're typically looking more in that 3, 4, 5 year window. They try to determine the normalized long-term earnings and whether the current stock price is reflective of that, and if there's an opportunity there. Each stock is characterized into an industry sector and ranked into quintiles. This bottom chart kind of shows the ranking of the analysts since inception. You'll see quintiles 1 through 5. Quintiles 1 and 2 on an annualized basis has outperformed the market. Quintile 5 has underperformed. So we think this is a good illustration of the fundamental research and their ability to determine what securities are attractive and which are not. You'll slide to the next one for me. Excuse me. Ultimately, they construct the portfolio. It's going to be driven by stock selection while concentrating risk into the highest conviction ideas. The PM's going to select from the most attractively ranked stocks. Typically, that means the first 2 quintiles, though not necessarily. The ideal holding is going to be attractively valued, or the insights of the team are differentiated from that of the market. They're going to have a high conviction, and they're going to look for what looks to have the most compelling risk-reward trade-off. The portfolio is going to be about 50 to 70 names. They aim for a tracking error of 2 to 4%. Historically, it's been in the lower range of that, more in the 2.5. There are sector and specific security weight guidelines at plus or minus 4% versus the index. Portfolio aims to be style neutral, with stock selection really driving performance. You'll see the borrow tilts, factor tilts on the bottom left. And while there's some that do exist, they're very minimal. If you look to the right, that's the excess performance on 5 and 10-year rolling periods, and you'll see consistent outperformance across time. I guess if you'll switch over to the next one for me, here's a snapshot of performance as of the end of the calendar year. really the first two bars, kind of what Steve was talking about earlier about Sharpe ratios and information ratios. The first two charts show strategies perform very well, top decile in both of those. This is in a grouping of about 270 different strategies in the U.S. large cap space. From an up-down capture ratio, you'll see, hard to see the numbers. Up capture ratio is 104, down capture ratio is 97, so it does protect on the downside. The one thing that I don't have in this slide that I know everybody's interested in is fees. They're offering a fee of about 28 basis points, given the size of the mandate we're talking about. There's some relationship pricing discount that would bring that down kind of into the mid to upper 26 basis point range. The emerging market strategy that we have with them, because of that relationship pricing, would also drop about 3 to 4 basis points off the cost of that. So that the cheaper quintile management for this type of strategy is around 24, so it's just outside of that cheaper quintile. So it's reasonably priced given what we think the strategy can do for us. One thing to note, our primary funding source is that internal factor base. We license an index to manage against. That costs us about 6 basis points, so that would be some fee savings there. So you can kind of think of this as more of the net of those two. If you'll slide to the next one, we'll talk about T. Rowe Price. Sorry, my voice is struggling a little bit today. T. Rowe Price, founded in 1937, also a publicly traded firm, manages about 1.6 trillion in assets, strategy AUM of almost 90 billion. This is a little bit different structure in that it's an analyst-driven portfolio. There's 28 industry specialists that's managed by a 5-member portfolio oversight committee, 21 years of experience in the industry on average, with 9 with the firm. From a stability standpoint, they've added 7 clients over the last few years. That brings them north of about 40 clients in this strategy. Net inflows of about 300 million. The investment philosophy is somewhat similar to JP Morgan in that the fundamental research is key. They differentiated sources can create a competitive advantage. Company earnings and revenues can be mispriced. They believe investors overreact to news, providing opportunities. They seek to add value over a full market cycle, opposed to any short-term fluctuations, because they believe leadership in the market is often difficult to anticipate. We'll slide to the next one for me. The process is maybe a little different than what you all are used to thinking about, with a PM sitting on top of the management of the strategy. This is a collection of industry-focused analyst-driven portfolios from a bottom-up stock selection. So capital is allocated across those analysts in alignment with the index weights that they cover for that area. So each analyst manages their own portfolio, expresses their own views and their own convictions based on their fundamental research regarding the business models and the management quality and the position within the industry, the valuation of the company. This is all overseen by that 5-member portfolio oversight committee. They assign the areas of coverage, they mentor and develop the analysts, they oversee their activity, ensure adherence with the portfolio constraints and risk controls. What you'll see there in the bottom left is, again, a borrow factor model. The risks do exist, very minimal, so this performance is really being driven by stock selection. To the right there, you'll see a 5-year attribution. I think this is a good illustration of that strength in the team's ability to pick stocks. You'll see the blue is their annualized outperformance. The green is from a sector allocation positioning, which is really just this residual of the stock picking itself. It's been a slight drag, but the purple is the accretive nature of the stock selection. You'll see that really all that excess performance is driven by stock selection. If you'll slide to the next one for me, please. So this portfolio consists of about 200 to 275 names. Typically, the relative overweights are just plus or minus 15 basis points. It's got a lower tracking error than the JP Morgan of about 1.75. Relatively industry and sector neutral. They do have a plus or minus 100 at the industry and a plus or minus 150 at the sector guideline band. Active positions can get to as much as plus or minus 100 basis points, but that's a max and typically does not happen. Really think this portfolio is interesting, and this bottom chart really shows kind of its all-weather nature. It's not dependent on factor or style leadership. It's not dependent on the direction of the market. So what you see there in that blue and green, those are growth and value markets since the inception of the portfolio, going back to 2000. And then the purple and red is the up and down trend of the market. This is relative performance, and what you see is their batting average, or the amount of time they outperform given the market, is 75% or better. So it's not dependent on whether it's a growth or value market or whether they're trending up or down. This is an all-weather portfolio. Stock selection drives the performance, and the average performance is kind of in that excess of 1% during those periods. If you'll slide to the next one, this is just a snapshot of the performance again. Sharp ratio and the information ratio, top decile. Outperformance on the upside, some protection on the downside, not as much as JP Morgan, but there is some degree there. From a fee perspective, given the size of the mandate that we're recommending, they're offering 24 basis points, which is right there in line with that cheaper quintile. Again, so pretty favorable fees given the expected performance of the portfolio. You'll come over one more for me. So this gets to the implementation and the sizing. So as of the end of the calendar year, we invested roughly $400 million across the U.S. large cap factor-based portfolio, which equated to about 3.3% of the public equity allocation. We're recommending retiring this investment, using this as the source of our primary source of funding for the new mandates. We believe the allocation should be more meaningful in terms of the attribution to performance. Therefore, secondary funding would come out of the internal S&P 500. Important to note, the two funding sources are U.S. large cap. That's what we're recommending in U.S. large cap strategies. So we're not changing the market cap structure of the portfolio at all, just the way we access it, and we think a little bit more efficiently. We would recommend upsizing the allocation and blending the two finalists, because the expected return can be improved while maintaining the current level of risk in the greater portfolio. We think the strategies complement one another. Both are expected to outperform over a market cycle, but they do so with differentiated return paths. T. Rowe Price, very well diversified portfolio, large number of holdings, a large number of incremental bets that are going to compound over time. JP Morgan takes larger active positions, creates the opportunity for greater excess return, albeit with a little bit higher level of risk. So their return path is a little bit less predictable. So we think blending the two yields a higher expected return portfolio, yet a smoother return path. They are correlated positively, but it's 0.5, far from a perfect correlation of 1. So we don't see this as a doubling up of a bet. We are seeking approval up to about 12.5% of the public equity allocation, with the initial funding being right there at that 6.6. We are asking approval based on those percentages, but for the committees, put that in the context for the committee, this gives you kind of the dollar amounts, what that would equate to as of the 12/31 sizing of the portfolios. You'll come to one more slide over for me. So staff and consultant believe that JP Morgan T. Rowe Price will be a positive addition to the public equity program, and by default to the greater KPPA investment program. While they're distinct, the shared philosophical belief in conjunction with their differentiated construction methodology yields complementary return profiles. Neither strategy rely on any style biases or tilt, but rather on the idiosyncratic stock selection to drive relative performance, which we think helps insulate the portfolio from any macro theme influences. The expected results, a more efficient global public equity portfolio with a better risk-reward profile and increased diversification, as both these strategies have very low to negative correlations with the existing roster of mandates in the portfolio. So we're recommending that JP Morgan U.S. Large Cap Core Equity Strategy, T. Rowe Price's U.S. Structured Research Equity Strategy, both be approved for up to 6.25% of the total global public equity allocation, with initial funding coming in around 3.3. Again, the primary funding source is going to be the U.S. large cap factor-based portfolio, with secondary coming from the S&P 500. That's kind of the end of my prepared remarks. Happy to discuss or entertain questions. So,
First, I'd like to commend Joe. This was and Wilshire. This was great work on a very large project. And stepping back, I think the starting point for us was Joe and I have talked a lot about the decision to retire that what I call the scientific beta, the factor-based portfolio. And again, more than just performance-based. While we have it benchmarked against the S&P 5, which it doesn't show well, it's actually performed consistent with how we thought it would perform given the tilts that it embeds in a portfolio. We just thought, kind of given the shift in markets and what it embeds as far as biases in the overall global equity portfolio, it was time to retire that portfolio. Our starting point was really, we were looking for one replacement, and to Joe's credit, he broadened that search and was really able to look at, again, bringing this recommendation for two managers that are in fact very complementary of each other, and together combined have a better result than using just one of them independently. So I think that was great. And Wilshire did a lot of work on this as well too, so appreciate that. And this was a lot of work, so happy to answer any questions.
Steve, I'd like to add to your comments and also to thank and congratulate Joe and Wilshire on, I think, an excellent job of basically, first of all, coming up with the idea of making an adjustment in our portfolio and our managers, and then the very thorough analysis you've gone through. The information you provided to us is very beneficial. And I think going through the material that you had, the two candidates that you're suggesting, I think look solid and a good justification for making a change to them. And again, thank you for your real hard work. I think this is a good example of what we'd like to see happen in the future, how we might approach making decisions about identifying areas where we might want to make a change, and then also to identify the new fund managers that we think are going to carry out our responsibilities and do it very well. So thank you very much. I was really impressed. So I'd like to endorse your recommendation. So other questions, comments?
I've got one question. I want to first off thank Steve and Joe for including Dr. Hackbert, myself in the final interviews with both J.P. Morgan and T. Rowe Price. I was very impressed with both of them. My question I did not see addressed in there, you're talking about blending the two. Do you have a target percentage on what you're talking about as far as blending? Is that a straight 50-50, or is that a 25-75, or what are we thinking here?
The initial funding would be the straight 50-50 kind of. As we run different portfolio scenarios with Wilshire, the models favor JP Morgan to a degree. However, that's based on kind of expected return assumptions. And so it's not significant enough to justify a significant tilt either way. And so we're going to initially recommend this 50-50 blend and see what our experience is with the mandates and how they perform. As we look for opportunities to potentially rebalance, we can kind of rerun those models, but those models are based on expectations. And so, like I said, they tilted a little bit towards JP Morgan, but not significantly. And so it's just not comfortable enough to come in here and tell you the correct number is 70-30 or 65-35 or something of that nature. Chris, I don't know if he wants from Wilshire, if he'd like to opine, if he's on this call. I think I saw him, but he had
so in the work that we did, we do have an alpha model. And to Joe's point, the alpha model is to help us point us in the right direction and provide us with some of those weightings. But to Joe's point, it was not definitive to push us into, let's say, a 75-25 weighting that we would want to overweight one to the other. I also want to point out, going through this process over several months with Joe, we started with a very wide net. And while we did have a qualitative screen on it, we ended up at two managers that these represent Wilshire's best thinking in this space. These are both managers that are on our focus list, so we stand highly behind these. These are high conviction strategies.
Okay.
Any other comments or questions? If not, just procedurally, just to file, I guess the procedure would be for this committee to make a recommendation to the full CERS board. Is that your understanding?
I believe so.
Okay. Would someone make the motion to approve this recommendation of the staff so that we can move it on to the CERS board full in their next meeting?
I'll be happy to make that motion.
Is
I'll
there
second.
We have a motion made and seconded that we recommend to the full CERS board the recommendation of our staff and working with Wilshire. Any other comments or questions about this recommendation? If not, we can proceed to vote. So the vote would be on the recommendation that the staff's recommendation for J.T. Morgan and T. Rowe Price be forwarded to the full committee for their consideration and approval. All those in favor, please signify by saying aye.
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 Opposed? Motion carries. Thanks, Joe. Thanks again for your hard work and also for your help with the Wilshire. We thank you as well. So we can move on to the next item, then, which is another real investment recommendation. And Anthony, if you would please present this recommendation.
Sure. Thanks, Dr. Hackbart. This first investment recommendation is for the Arctos American Football Fund. We have you guys have approved investment with Arctos 2 years ago. They are, as a reminder, they are a sports-focused fund. They take minority stakes primarily in the teams in the U.S. major leagues. So that's baseball, hockey, NBA, and then the hope was to get access to the NFL as well, which is by far the most popular and largest revenue and earnings of the sports leagues, and that did happen. The approval for institutional investment did occur last fall. Arctos, our manager, was one of the 4 groups that was provisionally approved to invest in the league, and they did so at the end of last year with the Buffalo Bills. The other deal that was also approved was Ares' deal with the Miami Dolphins. So those are the first 2 transactions that have occurred. The thesis remained the same as we had a couple of years ago in terms of having access to scarce assets that have contracted revenue streams that have obviously withstood many different economic environments, including COVID and the Great Financial Crisis, and have been, had low correlations to the public markets and produced great returns, which is kind of what we're looking for in this area of the portfolio. So this investment is in another entity because they're raising it so that they can take advantage of them being approved. So the evaluations for teams have gone up quite a bit, along with media rights, and so to transact in this space, it requires a lot of capital. And so the idea here is to have access to 2 to 4 teams, and so for diversification. In terms of the NFL, it's actually less focused on the local markets. There is obviously more value that each individual franchise can add in their local markets, but the valuation is underpinned by the national media deal that the league has, and so that provides each of the 32 teams with very large check every year, and so that's contracted, and so even the smallest teams to the largest ones all get that. So I'm happy to take any questions at this time. You've probably seen the memo that basically just outlines the NFL's one-on-one in terms of the sports leagues and in terms of revenue, profitability, and popularity. So yeah, happy to take any questions.
Yeah, and just for background, so the Arctos Fund 2, which was what was approved, as Anthony mentioned 2 years ago, that is going to invest across the major sports leagues as identified in the memo. And part of the structuring for the NFL, was Arctos' decision to have a dedicated fund. So initially we thought when we approved that investment in the underlying thesis was the NFL ultimately would get approved and would become part of Fund 2. Given the timing and the structuring, Arctos has made the determination to have essentially a dedicated fund. I think it have a small exposure outside of the NFL, but the majority of the assets will be the NFL. So the opportunity to invest will be through this vehicle. And as the memo mentions, we're scaling down the size. It's obviously not the size that we recommended for the full Fund 2, but this essentially gives us the diversification across the major sports leagues that we initially envisioned with the initial recommendation and allocation.
Steve?
So Anthony.
Anthony, a couple of points that caught my attention the other day when we had the call with Arctos that I think the trustees ought to keep in mind. Number one, right out of the gate compared to our past histories, this thing has a 10-year liquidity versus some of these other private equity adventures that we've been on that seem to go on forever. So there is if we choose to 10 years from now, we've got a way out, number one, without taking any significant haircut on the deal, as I understand it. The other thing that caught my attention was from a return perspective, the correlation during, let's just call it sideways markets, seems to be very positive. So I was impressed with that. I think it's a good opportunity.
Yeah, those are two very important points. And I think while this may fall into that private equity category, some of the liquidity provisions that are provided by the fund are important differentiators. And you talked about that 10-year exit. That's obviously in the documents with the expectation that the duration of the assets, I think the expectation is, a much shorter duration than 10 years. 65% of the assets inside of 7 years will be paid off. So return of capital to us. But then ultimately we would have a decision to make at 10 years if there was NAV left, whether or not we wanted to get our liquidity out or to roll our investment. And from a correlation standpoint, that's you hit the nail on the head. I mean, that's what we look for in this real asset. I mean, we've talked about how broad this asset category is, and the important things that we look at, especially, are the correlations to the bulk of our risk and assets are in these public markets. This is a great diversifier, and from a correlation standpoint, has very low correlation to those other assets in our portfolio. So it ticks a lot of our boxes.
Just to be clear, Anthony, this is an additional commitment. Is that correct?
It's a new commitment to their football dedicated vehicle. So the Fund 2 is closed, and so our commitment to that is there. And then the Fund 2 will actually invest in the football vehicle to gain exposure, but that it wasn't able to raise more money because that fund is closed. So that was some of the decision.
And about approximately 70 million. Is that correct? Yeah.
Say that again. Yes, that's what we are recommending, or
Right.
that's our proposal here is for 70 million. Yes.
Okay.
And again, overall, that would equate to, so that's about 30 basis points, and we would expect then the overall exposure to the NFL to be 35 to 50 basis points, which would include part of the investment that's in Fund 2.
Any other comments or questions? If not, we can proceed to consider this recommendation. Would someone please make the motion to approve the staff's recommendation to submit additional $70 million investment as discussed?
So
Move
moved.
approval.
I'll second.
Motion's been made and second. Thank you for your doing that. And any other comments or questions before we proceed to vote? If not, all those in favor, please signify by saying aye.
Aye.
Opposed? Motion carries. Recommendation is approved and will be submitted to the full CERS board at their next meeting.
Okay.
Next item on the agenda is the performance benchmark recommendation.
Sorry, Dr. Hyper. I have one more thing. If we can go to page 159.
I'm sorry, please.
Sorry. Yeah, thank you. This is an additional investment in an existing manager. This was also approved with Arctos a couple of years ago. This is our barge leasing manager, Maritime Partners. They are likely to call the rest of our capital from 2 years ago, and in this additional capital, later this year. They've been circling a few deals that would significantly add to their fleet. Kind of like farms, there's a lot of family or smaller I guess individually owned businesses that are in the space and with aging founders, and so there's likely to be turnover in that space. That was one of the main acquisitions they did right before we invested with the Flowers acquisition. There are a couple of those out there in the market as well as some other growth areas that they've been looking into, and so the capital will be used for that, and we would want to be ready to be able to meet that call when that happens. So that's what we're asking for approval here. This was previously delegated to the CIO, but there's changes to the IPS last year, and so as such, we're bringing it here for your all's review. I'm happy to answer any questions. The fund has done great. It's pretty much done what we thought. Full utilization. The supply demand dynamics are great. They're just basically any equipment around, so everything's utilized, and it's not economic to really build new ships at this point, given the closures in a lot of the shipyards and the rents or the prices and lease prices that just aren't. They have to go up quite a bit to incentivize new supply to come on. So I mean, we follow Kirby in this space. They are in the marine space, and you can see some quotes on the bottom of page 159. Their management estimate is that lease prices would have to go up another 40% from here to try and to get people to move. So there's quite a bit of room, and as leases expire, there's definitely double-digit gains on the renewal rates. It's similar to what we're seeing in our rail fund that was also approved last year. So it's a very favorable dynamic in these transportation equipment areas. So, but yeah, happy to answer any questions you guys have.
Yeah, so this is an add-on investment, as Anthony mentioned, to what was approved at the same time as Arctos. So we brought Maritime Series and Arctos at the same time, and all three were approved. Fortunately, a lot of the capital, a significant portion of our capital was called fairly quickly in this investment, and we're getting ready to have the last of our currently committed capital called. And as Anthony mentioned, given the dynamics and the outlook for the economics of this investment, I think it's appropriate to, this is one where it's done well, it's done what's expected, and the outlook continues to be very constructive. So that's why we're recommending an increased capital commitment to the fund.
Thanks for the clarification. Any other questions or comments of?
Steve, Anthony, I understand you say met our expectations. Can you define what our expectations were, and just as a refresher, give me an idea of what cash flow, what's going on with cash flow off this investment?
Sure, this is one that's definitely favorable. I know you guys value that a lot, and this is one where I'd actually like to reinvest, and they will not let us do it. So we get a check every quarter, and it's just cash. So yeah, we've gotten, I think, $10 or $12 million back already. And so unlike our open-end real estate funds where we just have them reinvest the shares, we're not able to do that here because they just send the cash back. So that's part of the cash flow.
Oh, 70 million more, right?
Say that again, I'm sorry.
I said they just call us wanting 70 million more, right?
Well, I mean, yeah, when the time comes, they don't call capital until I think the current amount is a certain percentage deployed. So that's why it's pretty lumpy. And so the other portion of our original commitment, along with this, hopefully, and several other new investors and other additions would all get called later this year, is what I've been told. So
on a percentage basis, what is that cash flow number?
Well, they underwrite to 10%. They underwrite to 10% right now. I talked to them yesterday, so the yields, unlevered yields right now are a little shy of 13. He said 12.75. So, but yeah, for conservatism, I put 7 to 10. So.
All right, thank you.
Any other questions or comments?
Well, I make a motion to approve the additional funding to Maritime Partners.
Thank you, Bill.
Second.
Got a second? Motion's been made second to make an additional commitment to Maritime Partners. Any other comments or questions? If not, we can proceed to vote. All in favor of the recommendation, please saying aye.
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 Opposed? Motion carries. Thank you very much.
Thank you.
That's it, Anthony, right?
That's it
That's
for me.
it for
Thanks.
Anthony. We're,
Thank you.
we're back to Joe, and hopefully his voice is recovered.
I apologize again, Anthony, for cutting you off. So we can move on to the next item on our agenda. And this, Joe is going to be presenting, as I understand, a recommendation about performance benchmark.
Right. So this is in the kind of the same vein that Mr. Cheatham expressed some concerns on private equity benchmarking. Is we want to make sure we're measuring ourselves appropriately so we can understand how things are going. And so we think that there's an argument to make that we need to look at examining the public equity benchmark. So as of right now, we utilize the MSCI AcquiNet to bench our public equity efforts against. Staff and consultant have determined that this does not represent the current investment exposure of the portfolio, and in fact embed some unintended biases within it. We're recommending that we adopt the MSCI ACWI IMI, as this benchmark represents a better alignment of our actual exposure. A little bit of background: prior to the latest IPS, we had targets to both U.S. and non-U.S. allocations, and those were benchmarked by regional performance benchmarks. On the U.S. side, we use the Russell family. On the non-U.S. side, we use the MSCI family. With the adoption of the IPS, the U.S. and non-U.S. targets were removed in favor of a global equity mandate, and the MSCI AcquiNet was adopted. We've managed these changes utilizing the existing roster of investment managers and strategies. We did this in order to provide the global exposure while also aiming to minimize any direct or indirect cost of a significant portfolio turnover event. The issue has come with relative performance deviations. Those are going to occur regularly due to tracking error, whether they're introduced from active management or actively managing position tilts along style or region or market cap. The problem is these deviations, they need to be able to be attributed to a known source. With the recent market environment of large cap dominance, the degree of that relative performance deviations, we couldn't fully explain it given the identifiable performance attributes or positioning that we knew of in the portfolio. This prompted us to initiate an investigation into the appropriateness of the current benchmark. And like I said, historically, we've used the Russell family for the U.S. side, MSCI family for non-U.S. If you look, there's a chart of kind of the public equity benchmarking, a little bit of a history there. I think it's maybe one slide up, 162 possibly. You'll see we use the Russell 3000 and then the MSCI ACWI ex-US IMI. We believed these were the broadest definition of the opportunity set for that at the time. With the adoption of the recent benchmark of the AcquiNet, we believe it created an unintended structural small cap bias in the portfolio, embedding a higher level of tracking error. So we initiated some discussions with Wilshire, with MSCI itself, and they confirmed our suspicions that the bottom 15% of the market's just not captured by that index. And as such, that confirmed our structural small cap bias concerns. If you look at that line graph on 163, I believe it is, you'll see the tracking error that we've experienced since the adoption of the new policy, and what the tracking error would be had we utilized the MSCI ACWI IMI. You'll see that in all cases, the tracking error is tighter. It decreases, and most recently with really that Mag 7 US large cap dominance, it's actually would have decreased by as much as over 40%. Our contention is a tighter tracking error is indicative of a more appropriate benchmark given the portfolio's exposure. As such, we would recommend that the IPS performance benchmark for global public equities be changed from the MSCI AcquiNet to the MSCI ACWI IMI. We think this will expand the investable universe of the benchmark to one that's more appropriate given the exposures and the strategies that we have. Wilshire, I think there's a memo behind mine that where they're in agreement with that, and happy to have any conversations or questions at this time.
Thank you, Joe. Any comments, suggestions, questions of Joe?
I think it seems fully appropriate to me.
Appreciate that. And this is, as we discussed, this is kind of, it's a continuous ongoing process. And I think it's appropriate that we review how we're being benchmarked, that the right benchmarks being used, and it's reflective of both the desires of the board from, they provide us the asset allocation, as well as the desires of the board for each of our programs. So I think this one's important. I think it makes sense. And obviously Wilshire and Joe have done a lot of work to determine the impact to the portfolio.
Yeah, I agree. I think it's a step forward. Again, we would ask for a motion to approve this recommendation.
So moved.
Second?
Second.
Any questions or comments? If not, we can proceed to vote. All in favor of the recommendation Joe has presented, please indicate by saying aye.
Aye.
Opposed? Motion carries. Thank you, Joe.
Thank you.
Item 11 on our agenda is the investment compliance review, and Carrie Bass, we're welcoming you to the stage.
Hello, thank you. Hi, it's nice to be here in the compliance officer position. I'm going to briefly walk you through the quarterly investment compliance report. It's got a little bit of a different look, but is largely similar to the report that you had previously, but of course with some changes based on recent IPS changes. I'll take the next slide, please, Sandy. We're going to start out with looking at the guideline review. All 19 of the guidelines were in compliance during the last quarter. No out of compliance findings. We'll go to the next slide, Sandy. The committee can see the guidelines that were reviewed during the previous quarter. Next slide, please, Sandy. And just a refresher on what to expect from this guideline compliance review. The guidelines included are those guidelines in the IPS and the guidelines of the external managers, internal managers, that are capable of a yes or no kind of response in compliance or out of compliance. I'll be looking at the entire quarter in question, and anytime there's an out of compliance finding, the committee will be provided with information on what that guideline was, when the start date of that out of compliance finding was, the cause of the out of compliance finding, the date of resolution, and what was done to fix that issue. Between now and the next time that you see me, I'll continue to work with BNY to enhance the reporting that is provided to this committee. You can go to the next slide, Sandy. The next component of the quarterly compliance report will be a brief asset allocation compliance overview. This is going to be an exception only report since you do get more detailed information on the asset allocation in your materials and other places. The next slide, Sandy. And if one or more asset class falls outside of the allowable range for that class, as stated in the investment policy statement, it will be noted here. The committee will get the asset class that was out of compliance, the range that the asset class should be within, the date the asset class came outside of the allowable range, what caused that, the date of resolution, and what was done to resolve that issue. Again, we'll be looking at the entire quarter. So if something falls out of the allowable range in the middle of the quarter, it will be documented here and not just looking at that last day of the quarter. To reiterate, this part of the report will only feature information where an asset class is outside of that allowable range. Are there any questions or feedback for me?
Thank you for your overview. I guess it's going to be a good report on our regular meetings.
Harry, I'd like to, congratulate you on the new position, number one. And I know it's going to take you a little while to get your feet on the ground. I'm sure I know the answer to this question, but have you had an opportunity to review the internal auditor's report on the investment office?
Yes, sir, I have.
I don't know whether that need at some point, whether it's the investment committee or whatever, I think we would all be very interested in hearing how you're going to attack some of those issues.
Of course. And just feel free to contact me and Mr. Rower outside of the committee meeting. I'm never one to be short on ideas for what we can do. That doesn't necessarily mean that my ideas are complete or couldn't use some feedback, but certainly I'm ready to get started.
Okay, thank you.
I think with that report, that concludes our meeting today. We've had a very full agenda, a lot of good reports, and with a lot of background of hard work and commitment to improving what we're doing. So again, Steve, Anthony, Joe, and the entire team, thank you so much, and Wilshire, your help as well. And with that, I think
I think Bill has something.
Bill?
Yes, Dr. Hackford, I just wanted to make the comment that this meeting and the preparation and the presentations included in this meeting were excellent. It shows that we as an oversight board are seeing the type of research and due diligence and collaboration with our investment people, and are doing a really good job in presenting their recommendations to us and their analysis that went into it. And I just want to say thank you, and that I appreciate how this meeting came across. So I just want to put those words out there.
Thank you
very
Bill.
much.
Yes, very well taken. Any other final comments? If not, I don't think we need a vote to adjourn. We'll declare this meeting adjourned, and thank everyone for your participation and the hard work that's gone into it. So that's it for today, and look forward